if you do want to learn more about some of these strategies, feel free to check out our website. We have a ton of information on our website, and if you're interested, we can get you more information about the Smith Maneuver calculator. There's also a course that Robinson Smith is offering on his website at smithman.net. So you can learn a lot more about the Smith Maneuver calculator. There's a course, and of course, there's a lot of FAQs and questions that a lot of you probably have. So it's good to check it out, learn more about the program. So it's time to start getting your retirement strategy in place. Make sure that you book a consultation with us today, learn more about how we can help you. By the way, the first 5 people that book a consult with us to learn more about the Smith Maneuver, I'm going to send you a copy of Robinson Smith's book. I have a bunch of them here at the office. And so the first 5 people that book a consult with us will get one of these books. And by the way, while we're talking about books, I'm also a best-selling author myself. Not to take away from Robinson's thunder at all, but I also released Rockstar Real Estate Investing a little while ago, and it's a book all about real estate investing. And so if you'd like a copy of that book, please reach out to us and contact us. So if you'd like to reach out to us, here's our contact information. You can visit us at www.greenmortgageteam.ca. And email is info@greenmortgageteam.ca. Phone number 604-229-5515. Thank you, everybody. What I'll do now is I'll open it up for some questions. I think I had a question or two in the chat here, so let me just open those up. So one of the questions is how much loan to value on the property do you need in order to be able to borrow money? So the maximum loan to value that the lenders will offer under the a readvanceable program is 80% financing. So they will not finance more than 80% of the value of the property. So if you put, let's say, 5% down on a property, then you would need to be able to pay down your mortgage down to no more than 80%. A lot of our first-time home buyers, what they'll do is they'll buy a property if they want to get into this, but they don't have enough down payment. Then they'll put 5% down, and then eventually, when the mortgage renewal comes up, hopefully by the amount that they've paid down in the mortgage, and if the value has increased, they may now have that 20% equity in the property that they need in order to be able to do that. Are there any other questions? Thank you. Actually, good question. So yes, we actually have a Smith Maneuver certified individual at our office, and one more of our staff members is going through the course right now. I think he's very close to being done. So very, very soon we'll have 2 Smith Maneuver certified individuals and agents at our office that are well educated and very well versed in being able to help you and dive into this, and also go into a little bit more of the advanced strategies that I spoke about very briefly today. Let's see here. So the money that you're able to take out from the property is only what is on the mortgage or based on the total value. So what happens is when you go to qualify for one of these readvanceable mortgages, you have to qualify typically based on your income. And so it's not just the total value of the real estate that you're able to access. That is one factor, but you have 2 limiting factors here. Number one is what your income will qualify you for. The other factor is you still can't go above 80% of the property value. So typically what the lenders are looking at is no more than about 44% of your gross income being used towards all of your debts. Here's the easy math. If you have no other debts, or if you're going to roll the debts into your mortgage, every $20,000 in income would qualify you for about $100,000 on a HELOC or home equity line of credit. I've got another question. So which lenders offer readvanceable mortgages? So most of the major banks offer readvanceable mortgages. However, some readvanceable mortgages are better than others. And this is where some lenders, for instance, only have 1 mortgage and 1 line of credit component, which is not very good for a lot of our real estate investors. There's a number of different nuances with every lender. Some of them allow a number of different mortgage or line of credit portions inside of it. Some lenders will allow you to qualify for more money. And some lenders even have a program or product where some of your income that comes in as you get paid will actually pay down your mortgage even faster. And so it can accelerate this method of paying down your non-tax deductible debt even quicker and opening up available money in the line of credit even faster. So it's something to keep in mind, is that Your bank probably has a product of some sort, whether that is the best product in the marketplace or not. That's something that you probably should get a Smith Maneuver certified professional to answer. Let's see here. I've got another question. Does it matter if the mortgage is on variable or fixed? No, it does not. The qualifications as of right now anyways are exactly the same, whether it's a variable rate or a fixed rate. Most lenders do offer a variable and a fixed underneath the mortgage components. There is one lender that only offers fixed rates under the mortgage components, and then the lines of credit are all variable, of course. But for the most part, it doesn't really matter whether you're fixed or variable. It doesn't affect the HELOC component or the readvanceable component. Let's see here. So I've got another question. Can't I just go to my bank and get a readvanceable? Yes, you can. Again, though, the products are very, very different. So yes, you could probably go to your bank and get a readvanceable product. Is that the best readvanceable product? That's another question for sure. And that's where we advise that you get some coaching and advice on whether that's the right product for you and which one is the best product. Another question, do I need Smith Maneuver certified professionals for anything other than my mortgage? Yes, I mean, realistically, what's happening here is the mortgage happens to be the hub and the central facility for everything else happening, but it's really important for you to get advice on all of the other key components to this. So accounting is probably the number one big thing that you need to make sure you get really good accounting advice. You need somebody that understands this product. There's a lot of accountants that do not understand the product well enough to be able to properly advise you on this, and so we do advise that you make sure that you get connected. The cool thing about the Smith Maneuver program here is that there's a really good community of individuals who are Smith Maneuver certified. So it's not just mortgage brokers. It's accountants. We have financial planners. There's a number of different people that are in this sphere, including even realtors, who can better advise you on what the best way to structure this is, because everybody involved in this whole transaction of buying and owning real estate and doing your taxes, et cetera, they should all understand how this is all intertwined. You don't want to get advice from one person and advice from another person, and everybody has their own biases. But if you have a group of people that are all like-minded and all are Smith Maneuver certified, then it makes it a lot easier. I have a question about advantages between HELOC versus refinancing. So a refinance can be adding a HELOC to your mortgage. So the act of refinancing just means that you are restructuring your current mortgage. Restructuring could be just giving you a regular mortgage, or it could be giving you a HELOC product. One of the advantages of just a regular mortgage is that you're just getting, in general, the mortgage rate on all of the money that you're borrowing. Now, some lenders do not have a home equity line of credit product. There's a lot of non-bank lenders that we work with, for instance, that are just really competitive on the interest rate, but they don't have a line of credit type of product. So sometimes, in some cases, some of our clients will opt for that. But I will say that most of our clients who are investors, who want to be saving money in tax and plan on investing some way, shape, or form, even if there's a small difference in the interest, the amount of tax that you can save greatly outweighs the amount in interest that you would be paying to get this product. Another question, does this cost me cash out of pocket each month if my line of credit balance is rising? So technically what happens is, as you pay down your mortgage, your line of credit limit is increasing. However, if it's just the limit, it's not costing you any money. Having access to capital available on your line of credit is not costing you anything. However, if you do start to take the money out, then your payments will start to go up. And so this is the beauty of the product too, with clients that are getting ready and set up to go out and invest. A lot of the time we'll say, hey, you know what, you might not need the money today, but why don't we get you a mortgage for the amount you currently owe? And then let's get you a line of credit on top of that, over and above the amount that you need. And now you have access to capital for the future. And now you don't have to worry about having to go back and requalify. And on top of that, as you pay down your mortgage, your line of credit limit will slowly automatically increase. So it doesn't cost you anything per month to have access to the capital. Eventually, when you do decide to borrow it, then yes, there is a cost. If it's a line of credit, then it's interest only. And if you decide to lock it into its own mortgage term, then it would be based off of a 25 or 30-year amortization, or whichever amortization you choose. I have another question. Is it possible to use line of credit not tied to home equity for buying rental properties? So From a tax perspective, the answer is yes, you can. From a mortgage qualification perspective, the answer is no. So lenders typically need to see the verbiage on this is that lenders want to see if you're buying a rental property that you're using your own funds, so your own down payment. And this means that if you're borrowing money from an unsecured asset, that is not your own money. However, they feel that if you're borrowing money from a secured asset, like real estate backed, then you're basically just getting access to your own money. That is the way that they feel about that. So borrowing money against an unsecured line of credit is not a valid source of down payment, unfortunately, especially for rental properties. Sometimes for owner occupied, there are some lenders that will consider it as long as you can pay for the payments. In general, lenders use a very high payment. So I think the payment on $15,000 of unsecured debt is higher than borrowing $100,000 on a mortgage, even with the stress test. And so they use a very aggressive payment for that. I've got a question in the QA here. So can you think of any monoline lenders who offer home equity lines of credit? And yes, the answer is yes. There are a couple of monolines. Not a lot of monolines offer a line of credit, but there are a few of them. I do find that they're a little bit more restrictive, unfortunately, and I really do like monolines. One of the reasons that I like monoline lenders, and for those of you that don't know what a monoline is, it's a lender that just offers one product, just a mortgage. So we call them a monoline or one line. These lenders, they typically have a difficult time funding lines of credit, and the reason for that is that most banks actually go out, lend money out to you and me, and then they bundle up mortgages together and sell them. Now, monolines don't have a balance sheet. They don't take in deposits. And so it's very difficult for them to go out and actually offer lines of credit because they don't have money sitting in the bank account ready to use for lines of credit. And it's very hard for them to bundle up these mortgages and then sell them out the back door, because it's really hard to sell to an investor, hey, here's a bundle of lines of credit. The clients may or may not use them. I don't know how much money you're going to make on it, but you have to have the money sitting aside in a bank account. So it's not easy for monolines to offer these types of products. The reasons I really like monolines is the way that they calculate penalties, especially on 5-year fixed rate mortgages. I find that the penalty cost with monolines is significantly cheaper than it is for major banks. In fact, in many cases, 3 to 5 times cheaper. But unfortunately, most of the monolines don't have the same product with as much flexibility. MCAP is a lender that I do like, and their product is fairly good. The only real 2 restrictions on that is that it's one mortgage and one line of credit, and it's max 25-year amortization on the mortgage portion. Let's see here. Another question. Can I build up a portfolio of stock with the monthly investment amount of $1,000 or so until I have enough of a down payment on a rental, and then sell the stock and put a down payment on a rental? I'm quite positive that you'd be able to do that. I would say that it's important for you to talk to your accountant just to make sure that there's no reason that you could not do that. But you should be able to do that. So you could basically just, as you pay down your mortgage, keep reborrowing the money back out, put it in stocks, slowly build that amount up. And eventually, once you have enough stocks, take the stocks, sell them all, pay down your mortgage. Now your line of credit bumps up again, and now you have a down payment that you can invest and borrow to invest. And now your interest is tax deductible on that portion. It's a very good strategy, Robinson, actually, because you'd be earning an income on the stocks while you're investing in the stocks at the same time too. So you're creating that spread that I talked about earlier, which allows you to accelerate it faster. And in fact, what you could do is with the gains on the stocks, on any dividends that you're earning from the stocks, you could actually take the dividend income from your stocks and use that to pay down your mortgage even faster too. Obviously, it depends on how much money you have invested in the stocks. If it's $1,000 per month that you're putting into it, you're probably not going to have a ton of dividends. It's any significant tax savings, really. But if you have a larger amount, then definitely you'd have a pretty significant tax savings. To obtain a HELOC, is your income taken into consideration, I assume? And the answer is yes. Yeah. So it is a common misconception that people think, oh, well, this isn't a mortgage, this is a line of credit, so I should just be able to get it. But a mortgage and a line of credit from the lender's eyes are the same thing. It's still secured debt. And in fact, it's actually slightly harder to qualify for a line of credit because of the way that they qualify the debt. So when you get a mortgage, they say, okay, if you're taking a 30-year amortization, then we're taking a 30-year amortization at the stress test interest rate, and that's the payment we use to calculate the payments. When you get a line of credit, they say, well, we're going to factor in on the entire limit the stress test rate, but on a 25-year amortization. So it can be much harder to qualify for a line of credit than a mortgage, just because of the difference in amortization when they calculate the stress tested payments.